Just to quickly explain what fractional advisory means, when you try and do a sales cycle to a bank and it takes 15 months, you realize you're actually consulting already. So I'm trying to create a model that solves that problem by selling my time on a day a month, 2 days a month, 5 days a month. And at the moment, I've got a project with a job title, which is the head of digital payments at PayInc, which I'm actually doing on a part-time basis. I've got a lot to get through, so I'm going to talk quite quickly. Pretend you're listening to a podcast on double speed, and you should be okay. So money is being tokenized. It's happening so quickly now. The danger of doing a talk or something like this is you get up in the morning and you find out somebody's done something crazy overnight in the States, and it sort of negates half what you're going to say. I don't think that happened. If it did, don't tell me. We've got three types of money, as you know. So we've got, when you think about tokenizing money, we've got central bank money. So you and I can hold notes and coins. The banks can hold accounts at the SARB. Then there's bank money, which is fractionally reserved. Risky, but we don't talk about it. That's a kind of bank magic trick. It's a liability of the bank. All money is somebody's liability at this point. And then we've sort of got e-money. We haven't really got e-money regulations in South Africa, but we have got e-money in the form of sort of MTN, Momo, and eBucks and Starbucks and things. It's kind of a loyalty program, so I've put a picture of my dogs up there. We can tokenize all these things as stable coins, deposit tokens, and CBDC. The loyalty thing actually is interesting from a stablecoins perspective. If you look at what's going on with stablecoins at the moment, one of the things that's starting to happen is people are realizing that if they own a system, if they have an ecosystem, they've got customers spending money, why shouldn't they own that money and benefit from that money? It's what Hyperliquid have just done. So Hyperliquid were very open about it and had a kind of auction for the money. If you want to run our money, come share it with us kind of thing. But anybody could do that. You could imagine Walmart doing that. You could imagine MTN doing that. And it's a short step from mobile money. And what tokenization does is give money superpowers. I like using silly pictures I find on these sharing sites. But I started trying to explain this, and I realized actually there's a nice quote from the Collison brothers on this one. It's cheaper, it's faster, it's decentralized, open access, programmable. Stable coins, tokenized money, but particularly stable coins, they're going to be the basis of the new financial system. The financial system keeps evolving, financial services keeps evolving, and stable coins is what makes that possible. So this is the next thing. Everything's going to be tokenized. If you disagree, we can talk about it later. But those three types quickly. CBDC came about, in my opinion, at least partly because of FOMO around what Facebook was doing. So Facebook launched Libra, said, look, we've got 3 billion customers. We're going to give them all a stable coin. And the central banks went, two things. No, you won't. Second, that sounds quite interesting. Let's go and explore this. Retail and wholesale versions of that. The SARBs already said they're not going to do retail CBDC. And I heard that again from a very good source yesterday. I think wholesale CBDC will get in some form, and I might touch on that a bit later. The interesting version of that is what the Bank of England's doing with Finality. So they've said, here's an omnibus account in the RTGS system. You can tokenize that. Finality's customers can then use what is effectively a wholesale CBDC to settle capital markets transactions and so on. And I think that kind of delegated CBDC or something is a good way of doing it. From deposit tokens perspective, he'd be JP if he was South African, but it's John Pierpont Morgan. The stuff they're doing started a long time ago. The banks are doing interesting things in this space now, and not just banks, asset managers, payments companies have been doing it for a while. And that's sort of true here. There's some cool stuff been going on. It takes a long time to do anything. But what they've got is their JP Morgan coin. They're transacting 3 billion a day, which is not much to JP Morgan, but it sounds like quite a lot to me. The interesting thing there, as I said, is they're doing this now. They've been doing it for a while. And if you look ahead, they're building the foundations that will support them when their tokenized money moves from the JP Morgan intranet blockchain to public blockchains, when their money becomes the basis of lots of things that other people are doing. And it's just a new tech for deposits. And I think that's going to evolve a lot further. They're enabling their clients to do cool stuff. You look at Ant Financial, who are, I think Ant Financial in terms of payments are bigger than Google and Apple combined. So take Apple Pay and Google Pay, add them together, that's still smaller than what Ant Financial do. So they're a pretty significant client. They're doing real-time 24/7 foreign exchange. They're doing treasury management, cross-border, all the stuff we know about that you can do because you can program money. And stablecoins we have here, we have a report from the IFWG, a so-called diagnostic of the stablecoin landscape. We don't have any good regulation yet, as you know. But if you look at stablecoins at the moment, they're crypto dollars. We know about USDC, USDT is a huge chunk. If you take those out, you still see a lot of dollars, and there's a whole lot of dollar stablecoins been launched in the last few months, or were announced in the last few months. It's 99.8% dollars last time I checked. So if you take away the dollars, what do you get? You get euros. take away the euros, this is what I think is a bit more interesting. Now, if you look at the scale on that, which you probably can't read, it's the current level is well under $100 million. So you compare that to 300 billion of stablecoins, it's a tiny portion. And if you look at those, they all look to me like little experiments, lots of little spikes in there. So there's lots of people playing with non-US dollar or euro stablecoins in lots of different currencies. And I think that's the interesting stuff for me. I'm not a big believer in the long-term viability of the circle model particularly. I think Tether has probably further to go. And I'm sure they see that as well, and they've got better ideas and know it better than I do. But the opportunity and the things that the people are doing with these experiments is really interesting. This is where the growth is going to come. And this obviously opens up the RAND stablecoins. I don't think, actually they're right on the bottom. The RAND is right there on the bottom. So there is a little bump in there. So the point of this tokenization, the point of this stuff is it enables that innovation. Now this guy is Clayton Christensen. I'm giving away my consulting roots here. You've probably heard of the disruptive innovation theories that he had. And he says in any market, and he was talking about steel mills and something else, hard disks or something. In any market, there's a level of performance at the high end of the market will pay for, and that goes up over time. And then there's a level of performance at the low end of the market will pay for, and again, that tends to rise over time with technology improving and so on. And incumbents create sustaining innovations to gradually improve what they're doing, so they do things a bit better, a bit faster, and so on. And then what happens is disruptors come in, and they start off with something that's kind of good enough, or it works for a small portion of the market. And you can see this exactly with stablecoins. They were very specifically, you can hold dollars without leaving the crypto system. And then use cases started to go from there. The interesting thing for me in this theory is that trajectory of a disruptor, which then overtakes eventually, or sometimes very quickly, the incumbent's performance, is that it's helped by sort of tailwinds of external factors. So if you look at the tailwinds around stablecoins, you've got clarity on regulation, you've got a broader crypto movement creating stuff that's then used by TradFi as they bring assets on chain and so on. You've got all these sort of environmental things, and you go from a point when we've got this money that's kind of, as Chris Dixon says, starts out looking a bit like a toy. Somebody's just playing with it a bit. It becomes something that overtakes things, and we end up with better money. And this is where the innovation happens. And people who are innovating around this stuff, they're not about taking risks. They want to build on something they know isn't going to go away. So bank APIs aren't trustworthy. Sorry to the banks, but banks recognize that you carry a platform risk if you're dealing with a bank's API. Whereas if you can build on something that's open, you can do more interesting stuff. And there's sort of bottom up and top down versions. The bottom up one, I'm sure you've heard of, the kind of Latin America version of Argentina, where I can go and take my pesos, buy USDT, and spend the pesos, similar to Money Badger or Pick and Pay, where I can spend my Bitcoin. So the dollar becomes a store of value because the peso is devaluing at 50% over the last 12 months. It becomes a means of exchange when I start paying with it, and over time it becomes a unit of account. You've dollarized the economy. From a top-down perspective, even the BIS recognizes, the Bank for International Settlements, even they recognize that cross-border payments don't work. They're slow, they're opaque, they're expensive. And they've experimented amazingly with automated market makers. So they had a project called Project Mariana, and there's a couple of others going on, they have run with euros and Singapore dollars and Swiss francs, and an AMM transacting between these CBDCs, which at the moment is all theoretical and interesting. The stablecoin version of that, or the sort of working version of that, is a stablecoin sandwich. I take my rands, I buy dollars, I send them to my brother in the UK, he sells my USDC for pounds, and off you go. I've solved that problem with just putting a few things together. And at the moment, that's quite easy, and it's only going to get easier. So in terms of the adoption and that kind of thing, that's anybody with any level of crypto expertise or knowledge or whatever is doing those kinds of things already. And what I'm interested in is the patterns of mass adoption and what I've decided to call the M-Pesa effect. So if you think about Kenya, we're all familiar with M-Pesa. It's been around since about as long as the iPhone, since 2007. So I take my shillings and I go to somebody, an agent in the marketplace, and he gives me a M-Pesa credit on my phone, and I can go and spend it. I can do cool things. I can send it over distance. I can go and spend it at merchants and so on. And then after a while, maybe I go back to the agent and I say, right, there's my credit back, and I get a handful of shillings back. What happens over time, of course, is I give up on the paper stuff, and I start using M-Pesa. I get paid with M-Pesa. Everybody's using M-Pesa. Everybody accepts M-Pesa, and M-Pesa becomes the system. So utility wins, and utility wins if you look back at the the Argentinian one, utility wins because the dollar doesn't decline against itself. The peso declines against the dollar. And the dollar is an interest-bearing instrument in Africa. If you look at the decline of African currencies, there's a bit of a kink in this, that something happened in the last 10 months that's weakened the dollar. But this debate about whether stablecoins should carry yield and stuff, dollar stablecoins are already yield-bearing instruments. So if you look at the Argentina one, the currency code for pesos really is nominal determinism or something. So I get paid in pesos, I buy Tether, USDT on Tron, and then I spend at the merchant, and the merchant cashes out for pesos. So I go to a crypto exchange, do this thing, have a card that accesses the crypto and spend it. And of course, what happens over time is that the whole thing becomes dollarized. In Africa, we should maybe be worrying not just about dollarization, but maybe I've been worrying about trying to say this renminbization, with the interest that the Chinese have in Africa, building infrastructure and trading and so on. So when you get regulatory clarity, when you get some idea of what's going on, and this is coming, if you look at the regulations around the world, and the States, Europe, Singapore, Japan, all got good ones, there's a consensus around what's going on. Who can issue stablecoins? Banks, PSPs, licensed entities. What's the collateral? High quality liquid assets, money market funds, repos, bank deposits, and so on. Where do you custody it with a licensed custody, bankruptcy remote, all that good stuff. All the sensible stuff is there. There's local nuance, and we'll get the same here. But when you get that clarity, and this is just the last 3 months since the Genius Act was signed on the 18th of July, you get a wave of innovation coming through. And these guys didn't start innovating on the 18th of July. These guys, Stripe and Visa and MasterCard, have been doing it for a while. The regulation opens it up. So what happens here when we have regulation? It's happening already. I can take my ABSA rands and I can go and buy a local stablecoin. EZAR or ZARP are the two I'm using as an example. I can do things with those, and they're both already building ecosystems that include use cases that don't work with bank money. They're building some cool stuff, and if you go find somebody from EZAR or ZARP, they'll tell you all about it. So I can use those things, and I can off-ramp as well. And the ability to off-ramp, the redemption back into ABSA rands at 1-to-1 means I actually don't bother to off-ramp over time. I just start to decide, actually, maybe this is okay. I'll keep using these things. The regulations, when the regulations are clear, when maybe money market funds become a tool I can use for settlement, we don't worry so much about the settlement in the books, the Reserve Bank thing that's in the stuff, then you end up at a point where stablecoins are money. And that's where we're going, no question. So what does that mean for the payments ecosystem? I'm finally getting to the point of my talk. This point, I must actually, what I forgot to say up front is the opinions here are mine and not PayInc's and not the Saab's. And so please don't say PayInc said this, say Paul said this. So this is the kind of discussions I'm having, and I'm being very open about where we are. And I don't have all the answers. I'm finding a lot more questions, if anything. So we need to counter dollarization or renminbization. And we need an innovation platform. And the reason for the innovation thing around stablecoins that I keep talking about and getting excited about it, if you look at what digital payments do, a growth in digital payments, there's a BIS study and a study from some long-winded journal there, long-winded name of a journal. But if you take their two things and you say, okay, 10% growth in digital payments, 1% increase in GDP over 2 years, that was the BIS study per capita, and 60 to 80% increase in GDP growth rate. I don't know if you can add those two things together, but either way, that's a pretty significant thing. Now, digital payments is not the same thing as stablecoins or as tokenized money. It is in PayInc world. I'm ahead of digital payments, which means tokenized for PayInc, but not in everybody else's world. But this is what's driving payments modernization, because we see this stuff and we say, well, we need this payments modernization program. We need to do things better. And there's a thing called the Payments Ecosystem Modernization Program, PEM, that the Saab is running. There was a position paper in July, and they said right up in the front, why are we doing this? 3 reasons: competition, innovation, efficiency, and allowing non-banks to compete. So opening up the system, making it easy for payments companies to participate in the payment system without having to go through a sponsoring bank who might suddenly decide they don't like crypto, or they don't like you, or they want to put your charges up, and so on. Second one is prioritizing inclusion and innovation, exactly that. Bank account penetration is not the same thing as inclusion. Penetration or inclusion means people actually using financial services and doing things that they otherwise couldn't do. And then the third one is reducing dependency on cash, having a viable digital alternative, which is obviously critical to any kind of Web3 finance. Now, what do we as PayInc therefore need to do, or what is PayInc's challenges? I think there's four things. One is the adoption of wallets. Unless people have got digital wallets, they can't hold digital money. There's the development of the ecosystem, there's the regulations, interoperability, and let me talk about those in turn quickly. This one, I think, is your problem. Creating better user experiences, innovating around wallets, getting people to adopt the use of QR codes, of digital wallets, of smartphone penetration, building that trust and experience. The better experience wins. If I've got a means of paying that does something better for me, and maybe it's incentives, maybe it is that incentive model that stablecoins can enable. But that's the job of innovators here to do that. I think the other three are more PayInc's problem. So at the moment, as I said, banks access the payment system. What PayInc does is make sure that ABSA RANs are the same as standard bank RANs, and they trade at par even though they're different liabilities of different banks. PayInc's role is to give access to that system to PSPs and to fintechs, to payment service providers and fintechs. And to do that by opening up the system with stablecoins or with tokenized money is, I think, potentially the simplest way of doing that. Probably better than having payments banking licenses or something like they do in Nigeria, and like it's been talked about. From a regulatory perspective, at the moment, we've got digital assets are a financial product, and we've got these things called CASPs that somebody talked about earlier. Digital assets covers everything from USDC to Bitcoin to shitcoin. That's a huge category of stuff that's just designed so we can tax it, I think. And CASPs is anybody touching those things and dealing with customers. So what stablecoin regulation will do is say, okay, there's a specific category of digital asset called a stablecoin, and here's a specific category of CASP called a stablecoin issuer, and give us some clarity around those things. And that will drive, that will reduce the regulatory risk, and that'll drive innovation. Then there's getting these things to work together and making sure that the ZAR at par, that's terrible, sorry about that. But there's sort of three ways that stablecoin issuers are doing this at the moment. One is programmability. So if I've got a stablecoin and it's on Ethereum, it's immediately available to DeFi and all these things, and you've got that interoperability through the programmability. Anybody can build on top of it. There's the fungibility one, where the stablecoin issuer is issuing basically the same stablecoin but white labeled to different people. It's what Bridge are doing with Stripe, it's what Paxos are doing, it's what EZAR's doing here. So it is the same stablecoin, it might have a different name on it, but it's just a rand underneath. And over time, we won't give a damn if we're using USDC or EZAR or ZARP or USDT or whatever. There will be stablecoins that we trust. They'll just be rands or dollars. And the second one is, or third one rather, is bridges and hubs. So the things that Wormhole do, Layer 0, Ubix is a really interesting project looking at clearing settlement of stablecoins. These are all sort of stepping stones on the way. From a PayInc perspective, now PayInc's role is as a national payment utility. It's becoming the role of PayInc is to create this kind of public good of a payment system. So SARB, as of 1st of November, so about 10 days away, this SARB will own a majority of PayInc. That transaction finalizes. This isn't privileged information, this is public now. It has been for a while. And that means they've got the ability to say, actually, let's try and solve nation-level problems as opposed to just sort of systemic problems. And they're operating as a public good and trying to solve some of these things. And what that means is integrating stablecoins. To my mind, this is my job at the moment, and this is kind of where things finish because I haven't got there yet, or have got there, but I haven't figured out the details, is connecting stablecoins to the payment system. How do you integrate tokenized money into the system? And one way, there's two obvious pieces. One is to say, well, let's plug stablecoins into the system. Maybe you create them as stores of value on PayShap and make them equivalent to bank accounts in the system. That's one way of doing it. The second way is to say, actually, maybe we need a whole tokenized system that includes stablecoins, it includes tokenized deposits, it includes maybe even a CBDC, and there's something bigger, and the whole system becomes tokenized. And I think over time, we end up with a tokenized system. We have to create a version in the meantime that helps us to get there and gives us the benefits as we get there. Maybe it becomes a system or it evolves into the system. That's difficult, and I've only talked about South Africa. The other problem is cross-border payments, and the next problem beyond just money is tokenize everything else, but that is maybe for another day. So I will finish as the clock says 13 seconds. There you go.